Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Pereira. With the latest macroeconomic data showing inflation at a record low and fall in factory output, the Reserve Bank of India is expected to reduce its repo or short-term lending rate at its monetary policy review on Wednesday. At its second bi-monthly monetary policy review of the fiscal on June 7th, the RBI maintained status quo on its short-term rate for lending to commercial banks at 6.25%. In doing so, the policy statement said that the six-member Monetary Policy Committee was guided by the risks to inflation. Retail inflation in India during June dropped to a record low of 1.54%, while industrial production data showed that the growth in factory production fell to 1.7% in May from 8% in the same month a year ago. Industry Chamber ASSOCHAM on Sunday urged the Apex Bank to cut interest rates in view of the latest macro data. On this edition of The Big Picture, we will analyze if a low interest regime is right for India. Joining me on the program today are CM Vasudev, former Finance Secretary, Renu, Kohli, former staff member, RBI and International Monetary Fund, Priya, Ranjan, senior journalist, and Kumar, Sinha, Director, Indian Ratings and Research. Thank you to all my guests for joining me on this edition of The Big Picture. I'd like to begin with CM Vasudev first. Mr. Vasudev, you know, media reports, analysts, traders, everyone believes that the Monetary Policy Committee is going to reduce the lending rate tomorrow. What's your view? Can we expect a rate cut?
Well, you know, of course, RBI as a monetary authority, its main job is inflation targeting, and for that purpose, it also has now an MOU with the government. And given the inflation numbers that we have, certainly there is a strong case for of the repo rates. I think RBI is a very unenviable type of a position. Inflation, of course, is low, but manufacturing growth is also very low. There are a lot of problems with regard to the bank's NPA stressed assets, and on top of it, demonetization, a lot of banks are flushed with liquidity. So it is really not a very easy choice. Because seen only yesterday the State Bank of India cutting the savings bank rate on its own. So how much the transmission of RBI cutting interest rates is going to take place is anybody's guess.
Right.
But I think given the fact that a lot of banks' stressed assets are on account of performance of the real economy, therefore maybe if interest rate signal is given and signaling effect pretty strong in the Indian system, it may also help in reviving growth a little bit, which will also help in the NPAs of many of the bank's assets. So I think that very strong case for RBI to interest rates.
I think there is some issue with the audio. We'll try and rectify that. Try and rectify that. Before that, let me go to my other guests as well and bring in an input from them with Renu, Kohli first. You know, what are the factors that ensure the RBI, or what are the factors governing the RBI when it comes to a rate cut?
Well, the factors are very clear. It is now an inflation targeting central bank, so its primary objective is price stability. Now, there are a number of issues here, and there is a lot of criticism in the past 1 month about the Monetary Policy Committee and the Reserve Bank's forecast errors. And I think it's very important to take on board or the concerns as to, you know, why these concerns have heightened so much at this point in time. Is it because commentators and in general are worried about underlying growth? Is it that underlying growth is much weaker than currently measured because of the, is it overmeasured or overstated because of GDP? Because, you know, let's face it, it did go down last quarter, but overall, I mean, 7%, 7.5% growth is not bad. So I think there is a kind of a contradiction there. Having said that, then again the inflation rate has fallen, and the criticism has been based upon that RBI's inflation forecasts errors have been very high, and there have been a number of attacks upon the MPC. So I would just like to say that it's only in the past few months that the policy path of the RBI has deviated from the inflation, and in January, when it took announced a pause and shifted to a neutral stance, if you look around, it is true that it is a fact that commodity prices, global prices, oil prices, global food prices, all of them were moving up. And in fact, the markets also expected US inflationary expectations to rise. So in that sense, since then markets have revised, and so RBI has faced that, a higher error. The second is the demonetization impact. It is not clear, and I think what the question before the Reserve Bank is likely to be uppermost is whether the decline in inflation is structural or cyclical. Because demonetization is something that affected both supply as well as demand.
Yes.
So, if it is on the demand side, then it has to take a certain view, and which leads us to, core and relationship of that with investment and which core and what what really touches manufacturing.
Sure. Mr. Dasher, how much of the whole farm loan waiver issue is going to be playing on the minds of the MPC? Because Urjit Patel, the RBI governor, has made his views about farm loan waivers very clear. So that's clearly playing on his mind.
Yes, of course, the farm loan waiver is an issue. But, how central it is to the question of whether we should, at this point of time, going in for a low interest rate regime. I'm not sure about that, because farm loan, both for and against, there is case to be made.
Yes. Sure. That's as far as the farm loan is concerned. But, I'd like to bring in Mr. Sinha. The immediate inflation data at the moment points towards, the data running below forecast. So is the time ripe for the RBI to cut rates?
Well, certainly the clamor for RBI to cut rate has been there for a fairly long time. It's not something new. And RBI has cut the rate over a period of time. I mean, if we look at from Jan 2015 till today, perhaps it's 175 basis point cut has already happened. And now the issue is that how far can RBI go in terms of cutting rate of interest? If the inflation target is 4%, and at the same time, if you want to maintain some kind of a real return on your money, that means that the current repo rate is 6.25%, and hypothetically we assume that the target is 4% and RBI is able to maintain the inflation at that. So the corridor between these two is just about 2.25%. So that's the real rate of return which investors would go. So somewhere RBI will have to balance both the aspects of cutting the rate of interest, aligning it in terms of where the inflation is, but at the same time not cutting it too far that it becomes a disincentive for people to save in the financial instrument and look for other avenues. And we have seen in the past that if you do that, it has its own implication for the economy. So it's not an easy job for RBI to, but if I have to look at the current circumstances, and if you are asking my opinion, then certainly I feel that there is a room for 25 basis point cut. I mean, if the RBI policy is concerned so far.
Ms. Kohli, the RBI, use this window before it closes to cut rates.
To cut rates?
Yeah.
Yeah, it's very important to understand that inflation targeting regime is a forward-looking policy. So, it's not the inflation outturn at present, last month, which matters really for the purpose of monetary policy setting. It is what the forecast is for 1 year ahead.
Yes.
Right? So that is why, as I said earlier, I flagged that the RBI has to now take a call whether the decline in inflation in inflation is structural or cyclical. If it is a cyclical downswing and it expects a rebound next quarter, for example, then the considerations would be quite different. They would not be that, you know, I mean, monetary policy cannot move up and down, you know, every quarter. But if it takes the view, if it thinks that there is a structural decline and, you know, whether it is a combination of demand side factors as well as supply side factors, or one of the either, which is why I said that it's very important to acknowledge and admit, since the clamor of interest rate cuts is so high, whether where exactly economic conditions are. Where exactly, because if you see the revised GDP number rebased to 2011-12, then it shows deceleration for the past several quarters.
Yes.
And if that is the case, then of course, then you have to acknowledge what the demand side conditions are. If demand conditions are decelerating, then what the real rate of interest ought to be. And then again, we are tied up in knots out there because, you know, if you look at it, the real rate of interest, Mr. Patra said in October 2016 that, you know, we're looking at something like 1.15, and the global real interest rates have declined. So what has been the evolution or the path of real interest rates since then? And then how does it correlate to your private investment, which is at the core of all this? Because in general, everybody is worried that private investment is not reviving, it is not showing a pickup. So what is the linkage between that real rate of interest and private investment, which brings us to the point, which is that the headline inflation is the target of the RBI, whereas if you look at investment, then the link between private investment and the real rate of interest exists via producer prices. But then you have a wholesale price index and you have a consumer price index, in which themselves are not synchronized. So it's not an easy task. As I said, it depends very much on the view that they take on what is cyclical, what is structural.
And it's a very difficult position for them to be in at the moment as well, because the clamor is loud and clear and everyone wants a rate cut at this point in time. Mr. Vasudev, you know, should the RBI remain an inflation targeting institution, or should it, you know, widen its scope?
No, certainly its primary job as a monetary policy authority is inflation targeting. And given the role which RBI has, there is no reason why it should not respond to the situation arising out of the current inflation rates which are so low. But I think also needs to take into account the fact that the demonetization effect of the economy is still playing out. It had led to a lot of demand compression and also maybe a lot of supply compression also in that period. So it will sort of lose the monetary policy a little bit. It will create demand in the economy. Supply side also will get a little push because of the lower interest rates, and therefore it will be good for the economy. And enough leeway in the system to provide for a little inflation to go up from 2 to 3 to even 4%. So given that we are a developing economy, and given that we are going through a process where the economy, especially the manufacturing sector, has slowed down, given that NPAs of the banks are very high, lot of which are driven by the lower poor performance of the real sector, I think there is a strong case for the RBI to cut interest rates. Having said that, I would also grant that the transmission effect of such cutting of interest may not be so obvious. It will be more signaling effect, because the banks post demonetization are already flushed with liquidity. We have seen the State Bank of India cutting the saving banks interest rate on its own. But I think it must signal that we are in for a low interest regime, which will give a push to demand and it will give a spur to growth. So I think all indicators are pointing towards a cut in the repo rates.
Okay, fair enough. Mr. Dash, low interest regime, good or bad for India?
Well, that's a obvious thing, you know. Everybody would like a low interest rate regime.
But that will also create a bubble of sorts.
No, but yeah, that is at the moment, looking at the state of the economy, you cannot think about a bubble, because if you look at the asset values at this point, it's not only the inflation rate is low, but even the asset inflation is very low. So there is no danger of a bubble as such. if the Reserve Bank of India is lowering interest rates. But to rely too much on lowering, so one has to look at interest rates as an instrument, or for that matter, the entire monetary policy as an instrument of both controlling inflation and boosting growth. Now, in both aspects, interest rates have a limited role to play. It's not the be all and end all of everything. Now, clearly there is, as Mr. Vasudev points out, there is a strong case, I would say, at this point of time to cut interest rates, and but whether that is something that's going to cause a miracle in terms of boosting growth. Growth has been slowing down for the last 4 quarters. We see that. So we've entered into a phase of slowdown. Now, is interest rate going to reverse that process? I'm not sure that's the case, because.
But at least it's a step in the right direction, is what you're saying.
Yes, you would definitely like at this point to have a lower interest rate regime, but whether that will be a solution, that will be that is something that will reverse the slowdown and growth will pick up. I'm not sure about the efficacy of a lower interest rate regime being able to do that at this point of time.
Sure. Mr. Sinha, a point that was pointed out by Mr. Vasudev was also the fact that, yes, the RBI can reduce rates at this point in time, but can the banks who are flush with cash and liquidity at the moment extend it to its customers?
Well, if you look at the period from 2015 till now, and you look at the behavior of the banks in response to the RBI's policy cut, then it is quite obvious that the policy cut by RBI has not been followed by the banks in a way that it should have followed. On the contrary, when RBI changed its stance of maintaining its liquidity close to neutral as opposed to in the deficit, which resulted in surplus liquidity coming into the system, and which then was further strengthened by demonetization, means more liquidity, the transmission have been better. So to believe that just because RBI cuts the policy rate, the monetary transmission would happen because they will respond to the rate cut has not been one-to-one. On the contrary, if you maintain a better liquidity into the system, we have seen a better transmission of RBI's policy into the banking system. So, I mean, net, what I'm saying is that, the policy rate cut is only one instrument to which the banks respond and eventually pass it on to the customer. There are several other issues. I mean, say, for example, the entire liquidity surplus have not been used by the banks to provide the advantage to the customer. A large part of that has also been used to actually shore up their profitability,
yes,
which is under tremendous pressure because of the rising NPAs. So going forward, a rate cut, does it mean that a rate cut would simply translate into a reduction in lending rate by the banks? Is not something which one can be sure about.
Yeah, there's no certainty in that at all.
Yeah, so
indeed,
that's the fact. But at the same time, one should also ask the question that I mean, the kind of situation in which the economy is, where a rate cut alone is the answer to all the problems that economy is facing. I mean, there are several other things that needs to be fixed. Then only probably economy will respond to the rate cut, not alone the rate cut. But it appears as if the narrative at this point of time is such that if rate cut doesn't happen, then probably that will be a disaster for the economy. And if a rate cut would happen, then probably it will be so good for the economy that everything will get fixed. I think we must come out of that narrative.
You know, I'm going to get to what needs to be done to spur growth and to revive the economy in just a bit. But before that, because Renu Kohli has been with the IMF, you know, what are some of the roles that central banks around the world play, and what are some of the best practices that probably the RBI can you know, take from them?
With respect to what?
With respect to interest rates, with respect to functioning, with respect to anything that the central, with respect to what a central bank really needs to do.
I think RBI has long always followed this best practice model, and it has, as an institution, it has always evolved and adapted to prevailing best practices. In fact, moving to, you know, whether it is provisioning norms for banks, whether it is recognition norms, income recognition, asset classification, Basel II or Basel III norms, which is with respect to regulation of the banking sector, with respect to monetary policy. I have been personally in the very critical of the shift to inflation targeting since its inception and even before that. But well, it is also one of the best practices for EMEs, by the way. So I would not fault the institution on that count at all.
Okay, fair enough. Okay, moving forward now, what needs to be done as far as reviving growth and, you know, spurring the economy is concerned? Mr. Vasudev, do you believe that, you know, some of the other panelists have also pointed out that just cutting interest rates is not enough, something else needs to be done? What more needs to be done?
I think it can be any case that cutting interest is a silver bullet which will cure all the ills that the economy is facing today. But certainly it is one of the factors. It is a very big signaling factor. It is a big factor which creates sentiments in the economy. So I think it is an important factor, but certainly it is not the silver bullet. But there are a number of other issues which I think need to be tackled, which I believe government is trying to tackle. The problem of the NPAs of the banks is, I think, the highest. In fact, that is one reason why the transmission effect of RBI monetary policy is taking place through the banks, because their taking capacity is quite low at the moment because of the very high level of NPAs. They have become more cautious in appraising new loan proposals, and they have become even more conservative. Top of that, as you mentioned a short while ago, the loan waiver scheme for the agriculture sector, which has spiked the NPAs of some banks because the farmers who were normally servicing the loans are waiting for loan waivers, so those NPAs are also building up. So I think the sooner the government deals with this loan waiver and provides the necessary fiscal support for doing that, and more effective deal of the NPAs by the banks through the mechanism that has been now worked out between the government and the RBI. I think these are principles which are needed to give confidence in the banking system that they can go ahead and start lending more and start lending at lower interest rates, which in turn will give more confidence to the businesses and the manufacturing sector to start making more investment. Because what we're seeing is a total, I think, a decline in domestic investment. Product investment is taking place is through FDI. So I think many of the steps which need to be taken in conjunction, along with more public investment for infrastructure, which is already taking place, perhaps a bit more of that. I think combination of many of these factors. Yes, and also GST, I think, is an uncertainty through which the businesses are going through currently. But I believe a month or two that will play out of the system. So whatever risk aversion in the businesses is there today because of the GST, that will go away. So I think a lower interest rate will give a big signal to the economy and to the investors. And if the bank, government are successful dealing with the problem of NPAs, probably it will be the more important, I think, factor in terms of the banking sector providing more impetus to growth.
Indeed. All right. Mr. Dash, your closing comments on the program.
Well, I would say that in so far as interest rates are concerned, the lowering of interest rates, policy rates by Reserve Bank of India, that has happened, 175 basis points. We are now almost back to the phase that we had started where interest rates had started climbing up. So there is still scope of 50 basis points.
50
after
basis
that,
points, okay.
After that, Reserve Bank of India would be left with no scope to cut the interest rate further. You do not really expect in India, the policy rate to move below 6%.
Yes.
Now that is insofar as so the limitation of the monetary policy in doing whatever they want to do. So this could be the last scope of 50 basis point. So whether Reserve Bank cuts it by 25 basis points, deficit for another 3 months, or does 50 basis point at this point, but that is the elbow room
that
in which
yes.
it has to play.
Sure.
I do not think that it has more elbow room than that.
Okay.
Insofar as the economy is concerned, and what is wrong with the economy, and the primary task is at this point, to my mind, is to boost demand.
Sure.
Demand, both consumption demand and investment demand. And in doing that, interest rate cut will have a small role to play. There are many other things that needs to be done.
All right. I'm going to cut you short because I've got 1 minute left on the program. Mr. Sinha, your closing comments.
Well, certainly. I mean, at this point of time, I guess, pinning hope just on interest rate is not enough. I mean, but at the same time, the reality is that there are external factors, there are internal factors, there are few things which you can fix, there are few things which are beyond your control, so you have to take it as it comes. So it's a difficult time, and my own sense is that both banks and the private corporate sector, which is not coming forth with their investment, are still in the process of repairing their balance sheet.
Sure.
And it will take probably another year or two. And
you're saying. Okay.
So long as that does not happen, interest rate alone will not be able to lift the investment in the economy, particularly the private corporate investment.
Ms. Kohli, close the show for us with your concluding remark.
I think it's very puzzling that everybody is surprised and looking at growth. First of all, there has been billions that there is robust growth, and now suddenly everybody is saying that, so I think it's very important to acknowledge the role of macroeconomic policies. After all, for 3 long years, 5 long years actually, you've had fiscal consolidation going on. That is contractionary. You have had monetary policy which has been very tight, I mean, until 14-15. So I think it's very important to acknowledge the role. Was the timing of the shift to inflation targeting appropriate? Has overtight monetary policy complicated the NPA mess? And what is the role of high interest costs, and whether that has aggravated the problem, and then resolution of that.
Indeed. All right. On that note, then we'll call it a wrap on this edition of The Big Picture. CM Vasudev, Renu, Kohli, Priya, Ranjan and Sunil Kumar Sinha, thank you so much for joining me on the program and putting things into perspective for us. That's all the time we have today. See you again next time.